It is 2026. Canada's headline indicators still give off signals of stability. The banks are open, the currency functions, the stores are stocked. But beneath those surface indicators, the structural data from 2025 tells a much darker story. Something is replicating a pattern that has shown up before most major economic contractions in the developed world. I am not looking at this as a trader or a politician. I am looking at it as a financial historian. And what the documented data shows, Statistics Canada, the Bank of Canada, the OECD, the IMF, is 5 structural fault lines converging at the same time. There are 5 fault lines in the Canadian economy right now. I am going to go through every one, but before I get to number 1, I need to tell you about number 5, because it is the one almost no financial commentary addresses. And the historical record identifies it as the mechanism through which every other problem becomes far harder to reverse. Here is the short version. Economies do not only break in the data, they break when enough of the most mobile people, workers, businesses, investors, quietly stop betting on the future. I will show you the documented evidence that Canada is beginning to show that signal. But the first 4 fault lines need to be on the table before number 5 makes complete sense. I am not here to tell you what to buy or sell. I am a financial historian, and my only aim is to show you what the record says. What you do with that knowledge is entirely up to you. Let us start from the beginning. Fault line 1, the housing debt trap. In 2023, Canada's residential real estate sector accounted for over 20% of its entire GDP. At the peak of the American housing bubble in 2006, real estate was 18% of US GDP. That was the figure economists used afterward to describe the American economy as dangerously concentrated in a single sector. Canada's number is higher, and it has been higher for years. That is not normal. 3 separate external evaluations reached the same conclusion. The IMF examined 38 advanced economies in 2023 and identified Canada as running the highest mortgage default risk of any country in the analysis. The UBS Global Real Estate Bubble Index ranked Toronto number 1 in the world in 2022. Bloomberg Economics rated Canada the second largest housing bubble in the OECD in both 2019 and 2021. These are not domestic assessments. They are from institutions with no stake in the outcome. Now the debt attached to that housing. As of the third quarter of 2025, Canadian household debt stood at 176.3% of disposable income, a figure from Statistics Canada's own national balance sheet accounts, and one that has continued rising. But the debt alone is not the mechanism. The renewal cycle is the mechanism. The Bank of Canada's 2025 Financial Stability Report documented that approximately 60% of all outstanding Canadian mortgages were scheduled to renew in 2025 or 2026. Of those renewing in 2025, the bank estimated average monthly payments would be around 10% higher than their December 2024 levels. For those renewing in 2026, the figure is closer to 6%. These are not catastrophic numbers in isolation, but they are landing on households already carrying the highest debt-to-income ratio among advanced economies, and they are landing simultaneously across millions of households in the same compressed window of time. The historical parallel is not 2008 America. That crisis was driven by reckless lending at origination, by loans that should never have been made. This is a different mechanism entirely. It is closer to the United Kingdom in the early 1990s, where responsible borrowers on fixed-rate products were exposed to rate resets during a period of rising unemployment. The mechanism was not irresponsibility. It was the arithmetic of debt service becoming impossible when the rate environment changed. The UK housing market fell 30% in real terms. Recovery took nearly a decade. The Canadian renewal cycle is larger in scale, more concentrated in time, and arriving into a labor market already showing strain. The Bank of Canada has been cutting rates, which has eased some of the pressure. but not eliminated it. The renewal shock is already in motion. Hundreds of thousands of households discovered what it meant in 2025. Hundreds of thousands more will discover it in 2026. That is the trap. Not that Canadians borrowed recklessly. It is that they borrowed at one rate and must now service that debt at another. But the housing debt trap alone does not explain the full picture. Fault line 2. The productivity collapse. By 2025, Canada was approximately 30% less productive per worker than the United States. That figure comes from the OECD, RBC Economics, and Statistics Canada's own labor productivity accounts. Business productivity fell 1% in the second quarter of 2025, following a further decline in the first quarter. On a year-over-year basis, it was flat against its pre-pandemic benchmark entering 2026. For an economy carrying this level of household debt, flat productivity is not neutral. Real income growth is what makes debt manageable. Without it, the same debt load gets heavier every year. In most recessions, productivity eventually recovers because the economy's underlying capacity is intact. The historical scenarios that produced decade-long stagnation, Japan in the 1990s, Italy in the 2000s, Greece in the 2010s, share a common feature. The productivity weakness was already present before the debt stress arrived. Canada's productivity gap with the United States has been widening for over a decade. This is where the story changes. The Bank of Canada's own staff research published in December 2024 identified what it called selective emigration of high-ability workers as a significant contributor to the productivity gap. Canada trains and recruits talent, then loses it. That is the mechanism, and the data is beginning to show it at scale. In the first quarter of 2025, 209,000 non-permanent residents departed Canada. That is a 54% increase from the same quarter the year before. Many were internationally trained professionals, engineers, technology workers, healthcare specialists, who had arrived through immigration programs and left for markets where their credentials translated directly into income. A 2024 Statistics Canada study found that over 25% of immigrants with foreign degrees were working in jobs requiring only a high school diploma. They arrived. They were underutilized. They left. A national study published in 2025 called The Leaky Bucket documented that 1 in 5 immigrants to Canada leaves within 25 years. The departure rate among highly skilled workers was among the highest in decades. The productivity gap is not a measurement problem. It is the documented output of a retention failure that has been building for years. Of these first two fault lines, which do you think gets less attention in the financial media? The housing renewal shock or the brain drain? Tell me in the comments. I read every single one. Fault line 3, the fiscal trap. In 2015, Canada's federal debt was $619 billion. By 2024, it had reached $1.2 trillion. It is projected to reach $1.4 trillion by 2028. The debt has more than doubled in a decade. Not during a war, not during a monetary emergency, but during a period of relative stability punctuated by a pandemic. Here is the consequence that matters. The government is entering a period of rising economic stress with significantly less room to cushion the blow than it had 10 years ago. Former Parliamentary Budget Officer Kevin Page told CBC News directly that Canada was losing fiscal space because rising debt interest charges were consuming a growing share of revenue. In 2024, debt interest payments surpassed defense spending for the first time. That is money that used to be available for economic stabilization, now committed before a crisis has even arrived. The historical record is clear on this point. When Sweden entered a housing and banking crisis in the early 1990s, constrained fiscal capacity meant it required a full banking sector restructuring before recovery could begin. When Japan entered its prolonged stagnation, limited fiscal tools, deployed too gradually, allowed the confidence cycle to take hold before the policy response could interrupt it. The difference between a managed correction and a prolonged contraction has consistently, in the documented record, come down to whether the central government had the capacity to act decisively at the moment of stress. Canada is entering that stress window with less capacity than it had 10 years ago. That is not an argument that a crisis is inevitable. It is an observation about the narrowed options available if one arrives. Up to this point, every fault line has been domestic: debt, productivity, government capacity. The fourth sits outside Canada's borders, and the historical record identifies it as the multiplying factor, the one that can turn manageable domestic problems into something that compounds faster than policy can respond. Fault line 4, the trade dependency: when 3/4 of your goods exports go to one country, your domestic stability is partly a policy decision made in another capital. In 2024, 76% of Canada's goods exports went to the United States. Trade with the U.S. accounts for 16% of Canadian GDP directly and over 2.6 million Canadian jobs when indirect effects are counted. That is from the OECD's 2025 Economic Survey. The documented historical pattern of highly trade-dependent economies when their primary partner imposes tariffs or contracts is consistent. The dependent economy does not catch a cold. It absorbs a structural shock its domestic policy tools were not designed to absorb. In the second quarter of 2025, Canada's real GDP contracted 0.4%. Statistics Canada documented this as the largest quarterly contraction outside the pandemic in 9 years. The primary driver was a steep fall in merchandise exports as U.S. tariffs on Canadian steel, aluminum, and automotive products came into effect. That contraction happened in a single quarter. The exposure is not theoretical, it has already been measured. No other G7 economy carries this degree of single-country trade concentration. Canada's current account has been in deficit for 17 consecutive years. The Canadian dollar is projected to trade between 72 and 74 US cents through 2026, a disadvantage relative to the US that the trade situation is actively compounding. The danger is not any single tariff decision. The danger is the structural leverage another government's choices have over the Canadian economy at precisely the moment when domestic conditions are already under stress. Now, fault line 5. I told you at the beginning this was the one without a clean data point, the one almost no financial commentary names directly. Economies do not only break in the numbers, they break when enough people, the most mobile, the most productive, the most forward-looking, quietly stop betting on the future. That is the confidence cycle. And the documented history of why some economic contractions become prolonged stagnation rather than sharp recoveries consistently points to this as the differentiating mechanism. It is not the debt level, not the trade exposure, not even the productivity gap. It is the point at which households, businesses, and skilled workers conclude that the fundamental economics of staying have deteriorated past a threshold and begin making long-term structural decisions based on that conclusion. Japan documented this after 1990. The economy contracted, but what turned a cyclical correction into 3 decades of stagnation was not the initial fall in asset prices. It was the cascade of decisions that followed. Households cut spending in anticipation of lower future income. Businesses stopped investing because domestic demand looked structurally weaker. The most mobile participants in the economy quietly began weighting their options differently. And this is the part almost nobody wants to talk about. Canada is showing documented early evidence of the same mechanism. The 54% departure surge in a single quarter is one signal. Business investment is another. RBC Economics has documented a decade of sustained underinvestment in Canada as a key contributor to the productivity gap. Pre-construction apartment sales in the Greater Toronto Area fell approximately 90% in 2024 compared to the 9-year prior average. The Canadian Home Builders Association's Housing Market Index reached record lows in the third quarter of 2025. A Bloomberg survey of 34 economists in May 2025 concluded Canada was already in the early stages of a recession. Each data point is individually explainable. Collectively, they describe a direction. The confidence cycle does not announce itself in a single headline. It accumulates in building permit numbers, in immigration statistics, in business investment surveys, in pre-construction sales data. Each reading is explainable on its own. The historical record shows that it is the accumulation that matters, and that once the cycle crosses a threshold, it becomes self-reinforcing in a way that policy finds far harder to interrupt than it anticipated. Japan spent much of the 90s waiting for confidence to return on its own. It did not return on its own. The stagnation lasted 3 decades. The intervention that eventually stabilized the situation required restructuring on a scale that the earlier period of gradual policy response had made dramatically more expensive than it needed to be. This is the pattern. And the reason the confidence cycle appears last on this list is not because it is the weakest fault line. It is because it is the one that the other 4 feed. Unresolved debt stress, declining productivity, narrowing fiscal capacity, and trade vulnerability, each of these separately is manageable. Together, they create the conditions under which the confidence cycle can take hold. This is not a prediction, it is a pattern identification. Canada retains real assets, a resource base of genuine global significance, a still-functioning institutional infrastructure, a central bank with demonstrated capacity to act, a workforce that remains highly educated by most measures. The historical record takes these seriously, and so should any honest analysis. But the same record shows something the headline GDP figure has been concealing. That number has been sustained primarily through population growth, and population growth is now slowing as the departure rate rises. Strip out the population effect and the per capita output story has been declining for 8 consecutive quarters through late 2025. Statistics Canada confirmed that real GDP per capita was still below its pre-pandemic baseline as of the 4th quarter of 2025. The structural deterioration the data documents did not begin last quarter. It has been accumulating for years, and the convergence of all 5 fault lines at the same time reinforcing each other is what makes this moment historically significant. Individually, each condition has a policy response. Together, they compress the window in which those responses remain effective. The question the historical record forces is not whether Canada is collapsing. It is whether the structural conditions the data documents are being measured clearly enough and urgently enough to produce a policy response before the confidence cycle makes that response materially harder to execute. That is what the documents show. In the next video, we examine one of the most documented cases of a developed economy that faced this same combination of conditions, and look forensically at what the policy record shows worked, what failed, and what the historical evidence suggests the difference actually was. Subscribe so you do not miss it. If this gave you a clearer picture of what the structural data actually shows, subscribe. And tell me in the comments which of these 5 fault lines you think Canada's policymakers are most underestimating entering 2026. I read every single